All right, so anyone dabbling in the market knows high-yield dividend stocks. Those are tempting. But here's the thing. The market's been on a tear this year. S&P 500 up a hefty 25% since late 2023.
Which is great for growth,
Yeah.
but it makes those juicy dividend yields a little harder to come by.
A little harder, you think. More like trying to find a unicorn.
Okay, maybe not that hard. But today, we are diving deep.
Into the world of high-yield, low-risk investments. And we've got a guide, Corey Renauer, over at the Motley Fool.
His November 14th article pointed us to 3 companies with some serious potential.
And get this, you could grab a share of each for about $130 total.
That's right. Not bad for a potential decade-long hold.
Okay, so before we get lost in the weeds here, can we talk about this whole yield thing? I mean, why are yields so low when the market's doing so well?
It's all about the dance between a company's stock price and those dividends they pay out.
Okay, bring it down for us.
Imagine a company, their stock's at $100 a share. They pay out a $5 annual dividend.
So that's a 5% yield.
Right. Now picture their stock price doubles to $200, but the dividend stays put.
So the yield gets cut in half.
Exactly. As stock prices climb in a bull market, those yields can shrink.
So basically, the richer the company, the stingier they get with the dividends.
So it's like quite that simple. But you can see how it's not exactly music to the ears of income-focused investors.
Right. So how do we find companies that are bucking this trend? The ones that are sharing the wealth, even when they're doing well.
Let's start with Brookfield Infrastructure. They own and operate a global network of assets.
Think energy transmission, transportation systems, even data centers.
Exactly. The backbone of the modern economy, which makes them pretty resilient even when things get rough.
Okay, so we're talking essential infrastructure. Got it. But how does this tie into the whole AI explosion that's happening?
That's where it gets really interesting. AI requires massive computing power.
Which means tons of energy.
And guess who's positioned to provide that energy backbone? Brookfield Infrastructure.
So they're kind of riding the AI wave without all the typical tech stock volatility?
You got it. And there's a little twist here. You can invest in their partnership units, BIP.
Which offer a 4.7% yield.
But there are some tax implications to consider. Or you can go with their corporate shares, BIPC.
Slightly lower yield at 3.8%.
But taxes are simpler.
Decisions.
Yeah.
Decisions. So how are they actually doing financially? What numbers should we be looking at here?
Well, they're currently trading at 5.1 times their funds from operations, or FFO.
FFO. For those of us who don't speak fluent finance, can you translate?
Sure, FFO is basically a REIT's version of net income.
So it gives us a clearer picture of their cash flow.
Exactly. And Brookfield's FFO is looking pretty healthy, growing at 7% year over year in their last quarter. They've also got an $8 billion backlog of projects.
So they're not just resting on their laurels. They're actively investing in future growth.
That's a good sign.
Precisely. Now, given all the economic uncertainty globally, does the stability of Brookfield's infrastructure assets make them even more appealing?
It's like a safe haven in a storm.
Yeah.
But let's not get ahead of ourselves. We got 2 more companies to explore. Speaking of consistency, let's talk about a company that's practically synonymous with reliable dividends. Realty Income.
Okay, I'm all ears.
They're a real estate investment trust, or REIT.
Meaning they own, operate, or finance income-producing real estate.
And to qualify as a REIT, they have to distribute at least 90% of their taxable income to shareholders as dividends.
Ah, so that explains the consistent payout.
And consistent is an understatement. Realty Income has paid dividends for 653 consecutive months, and they've been increasing those dividends for 30 years straight.
Now that's what I call reliability. What's their secret?
It all boils down to diversification and smart property choices. They own over 15,000 commercial properties, mostly in the U.S. and Europe.
Not putting all their eggs in one basket.
Their largest client, Dollar General, only accounts for 3.3% of their total rent.
So they're spread out pretty well. Makes sense.
They zero in on properties leased to businesses that are pretty much recession-proof, like grocery stores, pharmacies, dollar stores.
The places people go no matter what the market's doing.
Exactly. Now let's look at the numbers. They are currently offering a 5.5% dividend yield.
Pretty attractive in this market.
Their FFO growth is steady at 2.9% year over year, reaching $1 or 5 per share in their last quarter.
So their cash flow is strong enough to cover those dividends, which is reassuring.
They've also got a strong credit rating from Moody's.
Meaning they can borrow money at good rates, giving them more flexibility to grow and acquire new properties.
It all paints a pretty positive picture.
It almost sounds too good to be true.
Well, no investment is completely risk-free. But Realty Income's approach does raise an interesting question. In an increasingly unpredictable world, could their stability and consistency be a valuable asset in your portfolio?
That's worth thinking about. But we've got one more company to unpack, and it sounds like they're doing things a little differently. Realty Pharma. What's their angle?
They don't actually develop drugs themselves.
Okay, that's different. So what do?
They provide funding to pharmaceutical companies in exchange for royalties on future drug sales.
So they're betting on the success of new drugs without the risk and expense of the R&D.
Exactly. They're essentially investing in the pharmaceutical industry's overall growth and innovation rather than gambling on any single drug.
It's a clever way to mitigate risk.
Yeah.
Are they just throwing money at any new drug that comes along?
Not at all. They have a very selective process and a proven track record. Their portfolio includes 15 drugs, each generating over $1 billion in annual sales.
Wow, those are some serious heavy hitters.
They're not messing around, and they're hungry for more, with $10.1 billion already committed to future acquisitions.
Aggressive growth, but still diversified. So what about those dividends?
They offer a 3.2% yield, which might not seem as impressive as the others at first glance.
True, but they're playing in a different arena altogether. And their growth potential is huge.
Exactly. And for investors who are bullish on healthcare, Realty Pharma offers a way to ride that wave without betting on individual drug approvals.
I like that analogy. So if you're interested in pharma but wary of the risks, this could be a good fit.
Precisely. A unique approach that could offer a different kind of stability.
Okay, so we've got the case for these three companies: Brookfield Infrastructure, Realty Income, and Realty Pharma. They each offer compelling arguments for income-seeking investors. But let's be real, no investment is without risk. What potential downsides should we be considering?
That's the million-dollar question. Let's start with Brookfield Infrastructure. While essential infrastructure seems pretty stable, rising interest rates could impact their bottom line.
Because these projects require massive upfront investments, often financed with debt.
As interest rates climb, their borrowing costs go up, which could eat into their profits.
And they're operating in a heavily regulated environment.
Government policies could change and significantly impact their operations.
So political and regulatory risks are definitely factors to consider.
Absolutely. Now let's shift gears to Realty Income. Their long dividend history and diversified portfolio are impressive. But what about the potential impact of economic downturns?
Even essential businesses can suffer during recessions. People might cut back on spending even at their usual grocery store or pharmacy.
And while Realty Income focuses on brick-and-mortar retail, the rise of e-commerce poses a long-term challenge.
So even though they're focused on essential businesses, they're not immune to the broader trends shaping the retail landscape.
Precisely. And let's not forget about competition. Other REITs and real estate investors are also looking for those prime properties,
which could drive up acquisition costs and squeeze their profits.
Exactly. So there are definitely some potential headwinds for Realty Income, even with their impressive track record. Now, what about Realty Pharma? They seem somewhat insulated from the risks of individual drug development, but what else should investors be thinking about?
I'm curious too.
Even though they're not developing drugs themselves, the performance of the drugs in their portfolio is still crucial.
Makes sense.
If a drug they've invested in flops or faces unexpected competition, their royalty income could take a hit.
So there's still an element of uncertainty tied to the pharmaceutical market.
And competition among royalty-focused investors could drive up the prices they have to pay for future royalty streams.
Basic supply and demand.
Right. And we can't forget about the ever-changing landscape of healthcare policy. Changes in regulations or drug pricing could significantly impact the profitability of the drugs in their portfolio.
So even with their innovative model, Realty Pharma isn't entirely immune to political and regulatory risks.
That's right. These are all important factors to consider before making any investment decisions.
Okay, we've explored the potential rewards and risks of these three companies. They each offer compelling arguments for income-seeking investors, but it's clear that there are also some potential downsides to consider. What's the key takeaway here?
Due diligence is essential. Don't rely solely on dividend yields or catchy headlines.
So what's the next step for our listeners who are intrigued by these companies?
Dig deeper. Read their financial statements, research their management teams, understand their competitive landscape, and critically evaluate their growth prospects.
Investing shouldn't be a gamble. It should be an informed decision based on thorough research and a clear understanding of your own investment goals.
Exactly. And remember, diversification is key. Don't put all your eggs in one basket.
So it's not just owning bridges and pipelines. It's about anticipating where the world's going and investing strategically. What are some specific areas where they're focusing their growth?
One that jumps out is their investment in data infrastructure. As we discussed, the AI boom is driving a huge demand for data centers and the energy to power them. Brookfield is positioning themselves to be a key player, providing that infrastructure for the digital economy.
So it's not just physical infrastructure like roads and power lines. It's also about the digital infrastructure that's becoming more and more essential.
Exactly. And their global reach is a big advantage. They're not limited to one region. They're diversifying across developed and emerging economies, tapping into growth opportunities worldwide.
Smart moves, especially with all the geopolitical and economic uncertainty. It seems like they're taking a long-term view, building a resilient business. But we also talked about some potential risks. Can you elaborate on those?
Of course, rising interest rates are a risk for any company that uses a lot of debt financing. Their borrowing costs could go up, squeezing their profits. It's something investors need to watch, especially in the current environment.
And what about those regulatory risks? How vulnerable are they to changes in government policies?
It's a valid concern. They operate in a highly regulated industry. Changes in government policies, particularly about energy and infrastructure, could have a big impact on their operations and profits. Investors need to be aware of that, especially as the political landscape shifts.
So it's not just about financial performance. It's also about understanding the political and regulatory context.
Precisely. Now let's move on to Realty income. Practically a textbook example of stability and consistency in the REIT world.
Their dividend track record is definitely impressive. But beyond the numbers, what specifically about their strategy makes you confident they can keep this up?
It's their careful approach to property selection and tenant relationships. They're not chasing the most glamorous properties. They're focused on acquiring properties leased to businesses that provide essential goods and services. The things people need every day, no matter what the economy's doing.
Grocery stores, pharmacies, convenience stores. The places that are part of people's daily lives.
Exactly. They're not just landlords. They're strategic partners choosing tenants who are likely to weather economic storms and keep paying rent. It minimizes risk.
And their long-term leases provide more stability.
Right. Absolutely. They usually lock in tenants for 10 years or more with rent increases built in, predictable cash flow, less vulnerability to market swings.
That's like a built-in safety net.
Ah.
But you mentioned some potential headwinds. Could you unpack those a bit more? I'm especially interested in the e-commerce threat. How's Realty income adapting to the changing retail landscape?
It's a challenge they're definitely aware of. They focus on essential businesses. But many of their tenants are still brick-and-mortar retailers facing growing competition from online giants. So Realty income is branching out beyond traditional retail. They're investing in properties leased to non-discretionary service providers, like healthcare facilities and fitness centers.
They're recognizing the changes and adapting their strategy to stay ahead of the game.
That's right. They're actively evolving. But it's worth noting that competition for these types of properties is heating up.
So they're not the only ones who've noticed the value of these more resilient sectors. That could affect their costs and profitability going forward.
You're right. Something to keep an eye on. Now let's move on to our last company, Realty Pharma. They're turning the traditional pharmaceutical investment model on its head.
I'm still intrigued by their approach, participating in the growth of the pharmaceutical industry without taking on the same level of risk as traditional drug developers. Can you tell us more about their selection process? How do they choose which drugs to invest in?
They have a team of experienced scientists and financial analysts who evaluate each potential investment opportunity. They look at things like the drug's target market, its potential effectiveness, the clinical trial data, the competition, and the overall market potential. They're like venture capitalists, but instead of funding startups, they're funding promising drugs.
Combining scientific expertise with financial smarts, they're making calculated bets on drugs they believe have a high chance of success. But what if a drug they've invested in doesn't do as well as expected? What happens then?
Well, that's the risk in their model. If a drug underperforms or faces unexpected competition, their royalty income could be affected. That's why diversification is so important. They invest in a range of drugs across different areas, spreading their risk and not relying too much on any single drug.
Don't put all your eggs in one basket.
Right.
But their success also depends on getting good royalty agreements.
Absolutely. Negotiating those deals is key. They need to find a balance between getting good royalty rates and making sure the drug developers are motivated to make the drug a success. It takes expertise and a deep understanding of the pharmaceutical market.
And as you said, competition for those royalty streams is increasing. That can make it harder for them to get those good deals going forward.
You're absolutely right. Something for investors to think about as they evaluate Royalty Pharma's long-term prospects.
Okay, we've explored the strengths and potential weaknesses of each company. They each offer a distinct approach to generating income in today's market. As we head into the final part of our deep dive, what are some key things our listeners should consider as they weigh their options? We've been on quite a journey today, haven't we? Exploring these three companies, Brookfield Infrastructure, Realty Income, and Royalty Pharma.
Each with their own unique way of delivering those high yields everyone's looking for.
But we've also been careful to point out that those high yields, well, they don't come with a guarantee.
Right. We've talked about the potential risks, the economic challenges, the competition, and those political and regulatory factors that are always looming.
But I think it's worth emphasizing that even with those risks, there are still opportunities out there, even in a market where yields are generally low.
Absolutely. These companies show us that it's possible to find investments that offer both attractive payouts and the potential for responsible growth.
So you can have your cake and eat it too.
In a way. But as we've said throughout this deep dive, due diligence is absolutely crucial.
Couldn't agree more. Don't just take our word for it, or even Corey Renauer's.
Right. Do your own homework. Dig into those financial statements, research the management teams, understand the competitive landscape, and really think critically about their growth prospects.
And don't forget to consider how these companies fit into your own investment goals and your risk tolerance.
That's a really important point. Are you looking for steady income long-term growth, or a bit of both? What level of risk are you comfortable with? Those are questions you need to answer before you make any decisions.
And remember, diversification is key. Spread those investments around. Don't put everything in one basket, no matter how shiny it looks.
That's Investing 101. Now, before we wrap up, I'd like to leave our listeners with one final thought.
Go for it.
We focused a lot on yield today, but what about the potential for growth? Could any of these companies deliver both high yields and significant growth over the next 10 years? What factors might come into play? I think those are questions worth exploring as you think about your investment options.
It's all about finding that sweet spot, enjoying the returns on your investments today while also setting yourself up for the future.
Exactly. Building a portfolio that not only generates income, but also aligns with your long-term vision.
Well said. Well, that brings us to the end of our deep dive into high-yield dividend stocks. We've covered the opportunities, the risks, and the strategies for success. But remember, this is just a starting point. Do your own research, explore different options, and build a portfolio that reflects your own individual goals and circumstances.
And never forget, the world of investing is always changing. Stay curious, stay informed, and keep learning. Happy investing, everyone.